I'm just kidding.
He just teasing. Jack did want to talk about options prices today, though, which I'm interested to hear what he has.
Yeah.
Yeah, I am too. Do you want to get into that
Yeah. Just for a second, pull up NVDA.
on the chart?
Yeah. Now, just pull up like a month, a month.
Like the monthly chart?
Yeah, let's see the last 30 days, or,
Oh, on like the 5-minute or something?
on a daily, just so where
Okay.
we see that earnings date. What was that, the 25th?
27th was earnings this week. I mean, last
Go to the 27th.
right there.
That's the 27th?
Yeah.
Okay. So on the 27th, I was out all last week, but I got a decent position in NVIDIA, so I'm going to pay attention to that. And I'm looking at the stock, and this is what I'm seeing, folks. You got to check this out. So when you look at a stock like this and you're looking at the options prices, you can tell what the expected move is if you take an at-the-money put and an at-the-money call, and you add the price of those at-the-money options, you add that together, that's roughly the market maker's expected move on the stock, which turned out to be about close to $9. And as you could see that day, nothing happened.
Mm-hmm.
So every single person that bought calls and puts close to at the money lost 100% of their investment. And the craziest part about it is when you look at that expected move, obviously it didn't happen, but the market makers with the options, they've already priced in that 8% move. So the stock would have to move more than 8% just for you to see like a penny profit on your call or your put. And if that doesn't happen, then time decay is going to eat all that stuff up and it's going to go to zero. So this market maker expected move, or you don't even have to call it market maker, you could just say the expected move. It's not there. It's not happening. It's not the expected move. So don't believe that. What it is it's simply a hedge by the options market makers that don't want to get caught long or short and have to play catch up. So they're already pricing that option in, has got an 8% move already priced into it, which is why it's a complete sucker's bet. The stock would have to move more than that. And then these guys were buying these options on Wednesday, Monday, Tuesday, and Wednesday. They were buying them for that Friday's expiration. So the move happened a little bit later to the downside. But everybody that got in on those at the money calls or puts on that Wednesday, they got blown up. So what I'm saying, in long story short, is I've never seen options prices higher, only for the market makers not to have to cover their ass at a loss. So buying these options now, it's harder than ever to make a profit on it, unless it's a complete huge surprise. And that's how that is. So it wasn't the case with Google. That antitrust, they didn't have to sell off Chrome, and that stock popped. And those options paid off because the market makers didn't have the ability to already price the option too high to begin with. So you got to really think about just being an option seller in this environment, because that's where the money resides. I've been selling options all week this week, and it's just been amazing.
Why didn't you said Google, right?
Yeah, Google.
Why didn't they have a chance to set the price? Because it was after hours, like news
It
about
was just a surprise,
Yeah.
right? No one really saw that coming. I mean,
Yeah.
Marjorie Taylor Greene, or whatever her name is, she ran the thing, and she bought the stock the day before. She bought Google the day before because she knew she got illegal inside information. That doesn't matter. But see, these options market makers with Google, they didn't have a chance to price that option super high because they didn't know this news was coming. But they don't want to get caught is the reason these option prices are really high, because the higher it is, the more chance they have to not lose money. So when you're an option buyer, you just got to realize they've already built the expected move into the price of the option. That's why it costs so much. And that's why when you're an option seller, you're going to make more money than you ever have before selling options. Buying them is the hardest I've ever seen to make money. Buying options, just straight up buying calls, has been really, really, really difficult. Even when the stock moves, sometimes the option doesn't move because it was priced too high to begin with, which is again why you want to be an option seller.
Is there a particular reason that's the regime we're in? Is because people are kind of unsure footed right now where things are heading, how
Yeah, the market makers are unsure.
Yeah.
They really don't care about, when I was a market maker at NASDAQ stocks, I wasn't an options market maker. But the thing people don't realize about market makers, whether it's stock or the option, is like with the stock, market makers don't care if a stock goes up or down. They don't care. They're not trying to fool anybody or sneak anybody or push a stock down or push a stock up. That doesn't happen. What a NASDAQ market maker wants to see in the stock is he wants to see that stock go to a price that yields the most volume, because he's basically buying on the ask or buying on the bid and selling on the ask. And so he's making a couple pennies or whatever the difference between the bid and ask is. Once that stock settles in at a price that yields the most volume, that's where the market maker with the stock is going to make the most money. Same thing with options. But when you have earnings coming up, then you have drama and you have expectations. And now, unless it's a shock, like Google gapped like that because it gapped up, because it was a shock, nobody saw it coming. But with NVIDIA, everybody said, hey, this thing has got to make a big move one way or another. It's not going to just kind of stay flat. And it did. And I think that it's done that before, where the earnings hasn't moved at all, yet there's billions spent on options and they all got killed. So that's kind of the new thing. When you can buy a call on a stock that doesn't have an earnings date and doesn't have anything on the calendar, and you can catch a good drift higher, a good trend higher, that's where you're going to make money. But when all eyes are on NVIDIA and NVIDIA options, it's impossible, because the market makers don't want to get caught. They don't want to get burned. So they're already going to charge you that expected move built into the option price. So if they expect an 8% move up or down, it's got to move 10% just for you to see a nickel profit on the option. Bad investment buying calls and puts. Great time to be an option seller. I've never seen anything like it. Now, just to even take that home, mostly I trade tech because that's where the action's at. But Jeff Turnmeyer, he was doing this on the Gap, right? That's the most boring stock in the world. He did it on Urban Outfitters, and he did it on Dollar Tree. Just crazy. He's selling naked puts and making great money on that. So it's across the board. It's in high prices are in stuff like the Gap that's boring, and high priced options are in the tech world too. But being the seller is where it's at. Naked puts have been phenomenal. Credit spreads have been amazing. Covered calls, those three have been really where it's at, especially the naked puts. Man, that's been just unbelievable.
Yeah, well, speaking of NVIDIA, I'm looking on my unusual this column. It's the Ninja scanner, right? Unusual option flow scanner. Do have a lot of NVIDIA, actually. 172 $50 calls for September 12th coming in here.
Probably going to work, but what's the price? You see what I'm saying?
Yeah,
Like,
so 240 right now.
Much.
What'd you say?
That's way too high, right?
Right. I mean, I don't like to, with this, you guys can see this. I mean, so if you were watching this, we had two. We just got another two come in. So this is a pretty strong signal, actually. And we are bouncing off here of the 50 EMA. I should make that another color, shouldn't I? We are bouncing here off of the 50 EMA, but I try to trade cheaper options. Let's see what color should I do?
I gotta just point out this comment Earl made. You know, guys, I've been playing ANET for a long time, and Earl says, Jack, I heard you mention ANET yesterday. I checked the stock, checked the cash flow agent for a spread, got a put spread, put on the trade, and made a doubler out of it.
That's
Awesome.
sick. That's sick.
So we are talking about premium selling. That was a question in there. We talking about premium selling? Yep. Uh,
Yeah,
yeah,
Tim. Yeah, Tim was asking that.
yeah, we're referring to premium selling. Yeah.
Yeah, I mean,
Jack loves selling premium, Blake says. Yeah, I do. I love it like a fat kid loves cake. And the funny thing is, you know, when you're selling naked puts and this stuff, you can make like Jeffrey Turnmeyer was showing where he's making 40% a year without ever buying a stock. And most people in the stock and options market think you got to buy something and have it go up to make money. But in this world of income trading, you selling premium, you don't need to buy any stocks. You could just sell options all day long. If you're long a stock like NVDA, I got 7,000 shares. I sell covered calls on it every month. I'm embarrassed at how much I'm making on that. At Google, same thing. IBIT, same thing. Got naked puts on IBIT and a bunch of other stuff. ANET's been amazing. Yeah, selling premium is where it's at for me. I can't emphasize it enough. And it's so easy to sell a covered call, right? That's the easiest trade in the world. Naked puts, very, very simple. And then credit spreads.
yeah, I
But
mean,
that's what I got going on. What do you got going on, Alex?
well, I was just saying, I mean, I think this is the thing Google really needed to break out here. I mean, obviously it broke out, but hasn't it hasn't performed nearly as good as like some of the other big AVGO, NVIDIA. But if you look at Google's individual business silos, and I don't have the numbers, but you look at YouTube, you look at search, you look at they have the five different things. I mean, they're all $100 billion plus revenue generators, right? I mean, this is a Google is a titan of
Right.
tech. I
But
don't think I need to tell anybody that, but I'm just trying to reiterate that.
the funny thing about this Google trade is, you know, it's been underperforming and it hasn't been in the news and it doesn't have anything really cutting edge, although it does have valuable businesses. But everybody's been saying, you know, Google as a company is going to die because AI is going to take over search. So here you get the news that they don't have to sell Chrome, which everybody says was the worst part of their business, right? And you know, Chrome was nothing, and now they don't have to sell Chrome, and the stock goes up 8% in one day. Now, to move a multi-billion-dollar company 8% in one day, that takes a lot of buying, and it makes no sense for people to think that now that Google doesn't have to sell Chrome or divest of Chrome, that the company is 8% more valuable. Not the case. Not the
Mhm.
case at all.
Well, and Apple actually jumped on that news too, because part of that lawsuit was that um, Apple didn't have to automatic. So they were saying that basically Apple doesn't have to stop automatically loading Chrome as like a default search engine. That's the deal, right? I don't know if anybody knows that, but if you have an iPhone, right, when you turn up Safari, when you load up Safari, which is the internet browser, Google is the default search engine on Safari. So that was a big like antitrust thing that Google dodged and Apple dodged. So now Apple is up on the Google News too. And but again, I mean, look at this jump up. Apple, right? Shouldn't be moving like this.
Kind of crazy what's going on. Yeah,
Yeah.
Google is overextended now. We sold calls on it yesterday, covered calls, and I expect it to fade back a little bit, similar to what Microsoft did when they announced earnings. Stock jumped high and it's faded hard. Um, Bodine says Google is the one that is using AI best for search. That's true. But you know, you just might not see search to websites so much anymore. Just the answer will be on the AI app. Let me
Yeah.
answer this question.
Yeah.
Tim says, so when prices come down on a stock, that is when you go shopping for premium and then when the prices go back up. Nope. I don't, I sell first, Tim. I sell to open the trade. So I like it when the stock is high, going higher. I'll sell a naked put on the stock trending higher. Um, and I don't buy it back. I usually, if I sell an option, I like to let it expire worthless. I love that about options. There's nothing else in the world, maybe fruits and vegetables that you can sell now and they're going to expire at some point in the future. But this option, it's just a contract between two people, and the contract has an expiration. That's the expiration of the option. So Tim, I like to sell options, puts, naked puts on stocks that are trending higher and let it expire worthless. Or I got a credit spread on ANET this week, uh, and I'm going to let that expire worthless. And the covered calls, I'm going to let them expire worthless. So I don't wait for it to go down. I let it go up and then I sell it. Yeah.
Yep. Yep. So, and the idea is that Jack wants to get premium. He doesn't, I mean, he does, you don't mind owning the stock, but that's not really what you're, depending on your cases, I suppose, but you're not necessarily trying to just get the stock.
Sometimes I am. I did this 5 times on Archer Daniels Midland before I got the stock put to me. But by then I had collected so much premium, the price that I got it actually put to me, my cost basis was way lower because I had done it 5 times. Now with IBIT, I'm building a position in IBIT specifically so I could sell covered calls on it. And I had the 65 strike price naked puts that expired last Friday, and I got the stock put to me at 65. And here it is now 62. But as soon as I got it, I started selling covered calls against it, and I'm totally fine having the stock put to me at 65 because I made a nice premium selling that naked put to begin with. So for example, if I made $2 selling that naked put, I don't know what I got for it, but let's just say I sold a naked put at 65 strike price on IBIT and I make $2 and I have it put to me at 65. My real cost basis though is 63 because I got the $2 for selling it.
And
So
then your covered calls are,
and now I'm turning around, I'm selling another covered call. I'm making, $2 or $3 on that. So this thing can go sideways, up or down, and I'm turning it into just massive cash flow. So that's why I did. Sometimes I don't want the stock just because I want to keep the premium and do it every month. Other times I'll sell a naked put closer to at the money, not so deep out of the money, really deep out of the money if I don't want it, but I'll do it closer to the money if I do want it. And funny thing about IBIT was while I was in that, the stock went below 65 and I never had it put to me. It was only at expiration that I got the stock. So I'm totally fine with it. I'm building out that position specifically to sell calls against it every month because this thing has a great beta, right? The other thing about this is it's kind of trending higher and it has a great beta. A beta over 1 is what I look for. Beta is a measurement of volatility. So the broad market SPY has a beta of 1. If you have a stock with a beta over 1, then you're going to have more volatility in that stock, and that's going to result in higher options prices for you.
yeah.
So
And if you're on, this is not, I don't think this is right. This beta
it's
on
2.57.
yeah, I was gonna say if you can always reference the beta if you're using trading view. But I don't think they have accurate beta. So
No, that one does not. It's 2.5. Trades great liquidity. It's just been awesome. I'll tell you another funny thing that I've done this week since I got back is normally when I sell a covered call or a naked put, I'll do it on a limit, kind of between the bid and the ask, what they call the mark. But yesterday, let's see, it's Tuesday, I sold 5 calls on 5 different stocks, and I'd never used a limit order. I put every one of those for sale, whether it's selling covered calls or selling naked puts, I put it in at the market. And on 4 out of 5 of them, I got a better fill than the bid price. Really amazing. So that's what I've been doing. I haven't been using the limits. I've just been putting it into the market because what'll happen is it'll buy a market order has to be filled instantly at the market, whatever the market price is. So sometimes someone will be selling at the market and they'll just match up and I'll get a much better fill. I'll get a fill closer to the ask. And that's just a couple more pennies, but I just think that's very interesting how there's such an appetite for these options that even when you're a seller, you put it in at the market, you could get a great fill rather than going in on a limit.
Yeah, absolutely. And
I never used to do this, but I'm going to start doing it more at the market.
what do you think about AVGO? We got earnings coming up tomorrow.
Well,
No, tonight.
I'm long out the wazoo. And I've been long this thing forever. Pays a dividend. The Tan Hawk, this guy, he's almost as good as Jensen Wang. You know, I always like to look at when I look at a company, I always look at the CEO, the jockey, as I refer to, you know, because in this day and age, it's almost more about the jockey than anything else, right? You look at Apple, bad jockey. You know, you look at United Healthcare, bad jockey. Intel, bad jockey. You know, so that's just the story that I tell people. My Uncle John was a heavy gambler, never got married, always had on a nice suit, had about $3,000 in his pocket all the time. This is back in the 60s. Take me to the racetrack and you know, I'm looking at the horse's color and the tail and the mane, and I'm going to bet on that horse. You know, he'd give me $5 spread out on bets. And he starts laughing, and I said, "Well, what do you do? How do you pick the horse?" And he says, "I don't pick the horse. I make my bet based on the track record of the jockey, right?" So that's what I talk about when I'm looking at these tech stocks. You got to have a good leader, man. These guys, some of these guys, like the whole crew at Apple, and some of these other companies, Intel, United Healthcare, terrible leadership, terrible jockey. And then you got others, Jensen Wang. Doesn't matter. You're not going to knock this guy off the perch anymore. You can try to play catch up. You're always reading about how something in China's catching up to NVIDIA. That's a complete joke. This guy, he can shift and move and bob and weave like nobody else. So he'll be grinding it out and grinding it higher. Same with this guy at AVGO. I'm long a lot of this stock. I have no plans on selling it. I think it goes a lot higher. I love this one because you can sell covered calls on this to the cows come home. Even at 350, 360, you can get great prices. And you get the dividend, right? You reinvest that dividend, you're buying more stock, you're selling covered calls, you're taking that premium, buying more stock. It's good. It's all good in the hood.
Yeah, I wonder if they're gonna have let's go over to
Yeah, let's look at the money options here on the put and the call, and let's show the people the expected move.
yeah, let's do it. Let me move some stuff around here so I can see the stuff. Yeah, iPhone. I do have hood getting loaded up. I see it on my premium scanner actually. Was gonna pull that up in a second, but let's go first. Let's go to what we're looking at AVGO.
Yeah, let's figure out the expected move and then write it down because you'll want to see how does this move after hours, and you should all have access to after hours trading. Like Schwab has that, you want to have that.
Yeah, so I'm just gonna go ahead and all right. So AVGO, what are you looking for this week's expected move?
Yeah,
100.
Friday. Yeah, let's look
Yeah.
at Friday. What's an at the money call?
9:15.
Woo!
It's the mid.
Oh, what's an at the money put?
10:30.
Okay. So
$1.15.
1948, 19 and a half bucks. They think this thing is going to move by Friday up or down. That's not happening. So they priced that at $9. Can you imagine that? Yeah, that's high. That's a juicy option to sell.
Right. So
So you're
yeah,
looking at a $19 move after hours tomorrow or Friday.
which would be basically 323 or 3 what 80 87 or 287, sorry. So I don't know. That's a lot, man.
See, that's why I'm saying at that price at 9.18 and at 10.30 pricing on a call and a put, you can't make money. This thing would have to go. I don't know. It's a sucker's bet buying calls or buying puts here. People think that's going to give you the biggest bang for your buck, but not when it's on this earnings. What is Lucretia says? What's the risk of selling puts? The risk is that you get the stock assigned to you, and it hits lower. So when you're selling naked puts, Lucretia, you want to do it on stocks that are trending higher. You don't want to do it on stocks that are trending lower.
Yeah.
If you're doing the wheel strategy, the naked put is the first trade. That's the wheel is you do a naked put, and if you don't get assigned, you do it again the next month and you keep taking in the premium. If you do get assigned on a naked put, then you immediately turn around and start selling covered calls. That's the wheel. So yeah. Let's take a look at the guy who wants to see Hood. Are we done analyzing AVGO options? They're way too pricey.
Do you ever do like condors or anything, Jack?
I do sometimes, but the problem with the condor, folks, a condor is just when you got a credit spread below the stock and a credit spread above the stock's price. The problem there is you need the thing to trade kind of neutral, and it's easier to get one side right that you got to get both sides right when you're doing an iron condor. But the yield is high, and you don't have to add any more capital to the second trade in an iron condor. So it's a great efficient use of your capital.
It would work with such a high expected move though, because like you could just do pretty conservative bets on ABGO, for instance.
Yeah. Lucretia works with a small account selling puts. You just need to have if you're doing it naked put on margin, then you only need 20% down on the underlying stock, which is crazy. I don't know why that is. You need 50% down just to buy a stock on margin. I don't know why you only need 20% down on a naked put, but it's that 20% down, you got less capital in the trade. That's going to make the yield way higher. So doing them on margin is good. If you have an IRA, you cannot do it on margin, but doing it in a cash account is great. So if IBIT is at $62, you would need $6,200 in your account to enable you to buy the stock if you had it assigned to you at that price.
Because a put is every contract, Lucretia is 100 underlying shares, right?
Yeah. So when you're selling a naked put, you're getting paid up front. You're getting paid to make a promise. You're saying, if the stock goes to this strike price, then I'm willing to buy it. But you're going to get paid up front either way. So you're getting paid for a promise. I love that concept. Saying I'll buy AVGO at 300 or whatever, 290, you can pick your strike and your expiration. So it works great on a small account. You just have to be able to have the money to buy the stock if you get it assigned. Tim says same thing applies to a butterfly too, right? Yeah, that's right.
Yeah,
Stuff you got to get right.
I think butterflies it does like butterflies is your max profit is in like a pin. It's like a closer pin range versus a condor. So it's just like I think they can be a little more finicky than just a con. If you're gonna play those, I kind of prefer doing condors. I mean, I don't know what you do, Jack, but I would prefer condors over butterflies, just because there's like a larger.
I don't do either. I do heavy credit spreads.
Yeah.
Heavy. AVGO, ANET, NVDA, heavy duty credit spreads there.
Yeah.
I got one. You want to ANET? I'll show you. I got one that expires tomorrow.
Yeah, I just wanted to tell Lucretia. So if you do have a smaller account and you don't want to drop maybe potentially $6,200, you can do this on smaller stocks. Like it's the same concept, right? So for instance, I'm looking at you can filter, beta stocks under $20, So you're gonna get some Rocket Labs, you're gonna get some you're gonna get some smaller ones. I don't know actually if Rocket Labs is $20 right now, but $42. You can do $42. You could go even cheaper than this though, right? You could go only $20 with premium, high premium, high beta.
Yeah, institutions don't trade stocks really less than 20 or 25. So I don't want to be in one that's
Yeah,
retail trade.
right. That makes sense. Okay, Hood. Everybody wants to look. You want to look at ANET?
I'll just show you if you want to see a credit spread example I have in there. Then we can go to Hood.
Let's do it.
I own Hood as well. I own Hood. I own ANET. So right here on Tuesday, I sold the 127 strike price put and I bought the 126 strike price put. I love right now how there's just $1 difference in these strikes. You can really get it pinpointed perfectly. So I did that. I made 7%, a little over 7% on a trade that I put on Tuesday that expires Friday. I do that every week. So
What was the one you sold or you bought?
I sold the 127 and I bought the 126. So with a credit spread, when you're doing using puts, you're always going to get more money for the put you sell than you spend on the put you buy. And the difference is your net credit. That's your profit. So I think by tomorrow, this stock is still going to be over 127. So I'm not worried about it. Those options that are at 127, they'll expire worthless. And that's what I want to have happen. That way I keep 100% of my net credit.
When did you put
But
this
here
on
I'm
for the gap?
What's that?
Did you put this on after the gap up?
No. What was Tuesday? Yeah.
Oh, on
Yeah.
Tuesday. Oh, yeah. Okay, there you go. Yeah. Oh, yeah. That was a nice safe one. I would
All
say.
day long, baby.
Yeah.
Spread,
So
spread.
this is the one you sell for everyone who doesn't know, 127, and you buy the 125 or 126 rather. It has $1 with strikes. That's pretty good.
I like it.
Yeah, I like the ones that have the narrower strikes.
Before we move on to Hood, Doug says AVGO has earnings after the market today. Yes, that's true. For those of you following AVGO, do you think the stock goes up or down? Let's take a little informal poll on AVGO after earnings, up or down. Type
Who's
it
an
in.
AVGO expert in the audience? Let's hear, or even if you're not, let's just hear your hot takes. I'm trying to see let's see what other chip companies have had. Has they not reported yet? Nope.
Well, the interesting thing about AVGO is it's up, down by 5, Maggie says. iPhone says down, up. The thing about Broadcom I like is besides the chip, they're doing the switches and the routers, right? You got to enable this stuff to talk. So they have a little bit of a unique spot right there. Tim says probably will not be good enough for Wall Street. That's true. It won't make them happy. I always refer to NVDA shareholders like Will Ferrell in the movie The Wedding Crashers. You remember when that other guy comes to visit him? Can't remember his name. Owen Wilson. He comes to, and Will Ferrell's in his house, and he asks Owen Wilson, "Hey, you want some meatloaf?" And he's like, "Nah, nah, nah." And they start talking, and then he says, "Hey, you want that meatloaf?" He says, I think I will have some of that meatloaf." And Will Ferrell turns around and he says, "Mom, the meatloaf. We want it now." Right? That's your NVIDIA shareholder. All right.
Right.
Earnings, right? We want it now. We don't want to wait. So, like Tim says, it probably won't be good enough for Wall Street. That's the case, man. They want it and they want it now. And it ain't going to happen. It takes a little longer to play out. But yeah, NVIDIA went down after good earnings, and that happens because of guidance, right? So when you're dealing with earnings, you're dealing with two things: the number you read, and then the words that come out of their mouth. And the number you read, that's going to have its initial jigger to the stock because it's going to be better or worse. But then it's that guidance. It's what's the people say that's going to really move the stock after that. So watch out for that guidance, and that'll be triggered off of the actual number they report. AVGO, Tebow says AVGO is due for a dip.
I kind of agree with Tebow there. I think it's going to probably follow NVIDIA. Maybe not though. I mean, NVIDIA dipped. It was that guidance, right? It was their sales, their data center sales weren't quite as good, but
Yeah. So Deborah says, Jack, I have IBIT. How can I sell naked puts now and make a profit? Now, when you sell a naked put, you don't need to own the stock. Right? With a covered call, you do need to own the underlying stock, but with a naked put, you don't. You just pick the strike price you want to sell the naked put at, and you sell to open that put at the strike you want for the expiration you want. Piece of cake.
Blake is saying AVGO rallies. All right, Blake, I'm gonna hold you to that, man. You'll be here tomorrow. We'll see.
Yeah.
Um,
Yeah.
yeah. So yeah, if you do it when you're playing the wheel, playing puts, you get assigned. You just turn it around like and you sell covered calls on it.
Yeah.
If you get assigned, you don't necessarily want to keep on selling puts.
Unless you want to build your position. That's how I built out my position from 1,600 shares of IBIT to 3,300 shares.
Yeah.
See through naked puts. So I love that. All right. The good people want to see Hood.
Oh man, it's down bad. It's only back to the beginning of August in terms of its price.
I'm long Hood.
Yeah,
I think it's going a lot higher. The news that's going to come out here are going to be amazing. You'll be able to bet on anything, right? Like the poly market
are they
future.
rolling that out before football season starts in earnest?
I think so. They're going to have it all out there, you know.
Yeah. Yeah, I think this is actually a good entry. I mean, we have a nice little bounce off of the 50. Um, you know, it's a nice little sell off from all-time highs, right? One all-time highs, 117 or so. We're down to
Yeah.
103.
It's
So
great calls to sell. This is great for naked puts. This is great for credit spreads. This is great for covered calls. That's what I'm doing. I'm long the stock, but I'm picking a strike that's so high I probably won't get called out at, and just keep doing that every month. That way I can take advantage of Hood's rise in price and cash flow it at the same time. Doesn't get much better than that.
yeah, and every premium you collect, right? It just lowers your cost basis. It makes your trade a much more attractive. And when we say cost basis, right? So if you have Hood here, it's at 102. Um, would everybody know what cost basis is in the audience? If you don't, say you don't, because it's basically your true entry price. And what Jack was saying is like if you sell Hood's at $102 and you sell the $100 put, right? And then you collect $2 for that, and you get assigned at $100. Because you collected that $2, you subtract that premium you received from the price you got assigned at. So you're really getting in at 98.
That's your cost basis. Yeah.
That's your cost basis,
That's
right?
why that's why a lot of times when you get assigned a stock, you can turn around and sell it for the same price you got it assigned to you at and just keep the premium and no stock.
yeah.
It's hard to lose money on naked puts if you're doing it right. It is really hard to lose. But it's something most people don't do. So, that's where Jeffrey and I are really on Wednesday and Friday. We're really getting deep into the premium selling.
Yeah, it's a really cool strategy. Works good. Also, I mean, do you care about VIX at all when you're
No,
doing
I think it's broken.
It is. I was reading this crazy thing on X about some of the currency. Oh, I forget. It was pretty complicated, but basically some of the currency shenanigans are actually suppressing, but it's being artificially suppressed. So this is not like an accurate reading anymore of what volatility actually. And could it
Never in
be? I
my
mean,
life.
you see
Every
Apple moving so much, you see Nvidia moving so much. These are some of the biggest companies in the world. It's like, come on, and VIX is at the lowest. I mean, sub what,
It's
12 right
broken.
now?
It's broken. And everybody that I kind of grew up with in the industry, you got to remember I started in 84. They always look at VIX. Everybody looks at VIX. Pro traders I know look at VIX. amateur traders, retailers, everybody looks at VIX. I've asked people a million times, when you look at VIX, what is it you see? What edge are you getting by looking at VIX? VIX, for you folks out there, is a measurement of volatility also. Say when VIX is under 20, you want to be buying calls, or when VIX is over 20, you want to be selling premium. And I don't get it. I just, there's so many indicators out there. I just, like Blake says, it's a tool. There's too many tools out there. I don't use the VIX at all. There was a 0 days to expiration VIX. I don't know what they called that, the DVIX or OVIX or whatever that was. That was a little bit more accurate, but I don't play the VIX. Do you look at VIX, Alex?
Not really. I'll use it. I'll check it, but I don't. I mean, again, we have pretty. If you look at the levels of VIX, I mean,
So what is it supposed to show you? And how would you explain it to the people what the VIX is?
well, it's. I mean, the easiest is just to say it's a volatility measure, right? So, so when
Index of
basically volatility, when things are selling off, volatility is higher. So I think like if VIX is dropping, right, that means that generally you're in a secular uptrend. But if it's going, so if if VIX is dropping, you're in a secular uptrend. If VIX goes up, for instance, you can see it spiked in the beginning of August. We had a sell off. But to me, it's kind of like to me, VIX is kind of like a chicken or the egg thing, because it's like, okay, is a sell off causing volatility to spike, or is volatility causing like where is it like? It's almost just like I mean, if you see, you go back to August, everything started selling off and VIX went up. So does it have any predictive power for anything? You could have seen that if you go to an Apple, NVDA hood chart. You could have seen that. I don't think like volatility is just it's not like this is a indicative tool. This is a observational tool rather than indicative. This doesn't cause anything to happen. This chart you're looking at doesn't cause anything. This is just a measure of what you can already see on the charts yourself.
It doesn't even really reflect volatility. And the proof of that, that's not an opinion. The proof of that is what we just talked about, the expected move. You're looking at a price at $9 option and a $10 option on AVGO at the money. Well, how could volatility be so low if they're pricing the options to have all kind of crazy volatility? The options prices are the exact opposite of what we're seeing in this. Low VIX means low volatility. Options prices are priced for super high volatility. So that's why I think the VIX is broken. You could just look at options prices and tell.
Brandon had a good question. Do the market makers use VIX to price options? So options are priced using the Black-Scholes model, but I don't know. So hypothetically, I guess they would use it, but it doesn't seem that they do use it really anymore. Maybe they did in the past and a yesteryear. I don't know.
Yeah, I think the Black-Scholes, I don't like it either. Now, the Black-Scholes model, for the good folks at home, it was developed by two guys, a guy named Black and another guy named Scholes. And, well, yeah, I'm just saying, you know,
No.
both Black and Scholes never made any money. So why would I follow their model? You know what I'm saying? I wouldn't even, I don't, you know,
Well,
and again, I like to self-diagnose myself with adult ADD, which means I don't have to read the Black-Scholes model because I can't read it. So have you
Uh-oh, we lost Jack for a second there.
He gone.
He's gone. The big market maker didn't want him telling everybody the truth about Black-Scholes model.
That's right. He said that out loud, and they're like, "Whoa, hold on."
No, seriously, have you ever read it?
The equation?
Yeah.
Well, yeah. So what's interesting about it is that it assumes that volatility is constant, which is interesting because
assumption.
How could if it was constant, it wouldn't be volatile at all.
Right. Yeah. Right. So here we are today, folks. We're throwing the VIX out the window. We're
Yeah.
throwing the Black-Scholes model out the window. We're showing you how the expected move is a bunch of BS and why you should be a premium seller. So you don't need the Black-Scholes. You don't need the VIX. I don't even use the Greeks. I've never used the Greeks one time in my life in 40 years of trading. So, you don't need all that stuff. You don't need to learn about all that stuff. Like I say, I like to pretend I got adult ADD, so I'm not going to read the Greeks because I wouldn't have the time or I wouldn't understand it. But I've made a pile of money trading options, and I've never used the Greeks, and I've never used the VIX. So, if Homer Simpson can do it, you can do it. And I'm the Homer Simpson of the trading community.
Well, whatever you're doing seems to be working there, because check out this nice little testimonial from JD. Maybe you want to grab this one for Jack Blake, because this is sick. JD said he does mostly credit spreads and started at 10K in May. Now he's at 52K.
Who's that?
JD,
Oh, wow.
10 to 52K.
My internet connection keeps cutting out. I got the Starlink, and
Nice.
the Bears came and tore up the apple tree, and they knocked the dish sideways when they pulled the tree down. So
Oh wow.
got spotty connections.
Yeah, well, that's an awesome testimonial. 10K to 52K. He's also asking a question. Why do people want to buy his, so if he's selling a put, why do they want to buy that put way out of the money? It seems like a big gamble on their end. That, he wants to do some naked puts. He's just trying to get a clearer idea about, kind of the structure of why these trades work, why people even want these things.
That's a great question that I don't have the answer to, because like if you pull up an options chain on NVIDIA, if you could,
Yeah.
you'll see open interest at the 25 strike price call or put, or the $5. They had a $5 strike price call and put on NVIDIA, and the open interest on it is incredible. Why would someone do that? I don't know, but everybody has a different strategy going on. And when you're making a market, you have to stand ready and able to buy whatever anybody's selling.
Yeah, yeah, it's probably like what Brett's saying. I think you're probably right. I mean, it's hedging. Like there's different strategies that big money has to use to hedge their positions, right? So,
Right.
um, there's there's whether that hedging is some of that hedging is done by actually, like delta hedging is done by buying underlying shares of the stock to edge their options positions, but sometimes it can be done via buying at the opposite, right, call or put, to measure out your position, to hedge your position, so, and even it out.
One of the worst traders I know always wanted to know, why would a market maker buy this from me or sell this to me? And you're thinking like, well, if I'm buying it and he's selling it, I must be on the wrong side. But that's not the case. There's just so many millions of strategies going on and millions of reasons why that there's a market for everything. But look at those really crazy out of the money options on NVIDIA or anything. I can't believe there's open interest on stuff that's got a.
Yeah, and you're also, I would love to get Jack's you know take on this, but so basically, and Jack, correct me, open interest is basically the market maker's book that they're opening up to trades, and the volume is the people who are actually trading that strike, right?
Yeah, the
So,
open interest, the volume is for that day. The open interest is what contracts are out there that haven't been assigned or sold.
right. So the market maker has, I mean, if they'll open up demand for a strike, just, we can make a few cents on the spread. And then if people are willing to, and these are retail traders too, right? So we can't, I don't think we can discount the amount of retail trading that's going on in the options market. I mean, these retail traders are taking, this 149 put saying maybe. I mean, no, I think it's so it's not only like big money that's creating the volume on this. It is regular options traders too. And I think
Mostly retail traders. Yeah,
yeah, so but and like again, if there's demand, the market makers will create the market. Is that right?
that's correct.
So
That's why some stocks that don't have options yet, there's just no demand, and you'll have an IPO and it'll have options available the next day, because
yeah.
the options market makers, they want to make a market in it, as many as they can, but they want to price it so they don't get hurt. And that's the rub right there. You can't price a stock like that. You got to make a market. You got to buy it and sell it, bid and ask where that market is. You don't get to price the stock crazy, right? But with options, they do. They get to price it how they think the market for that option is. And it's way too high priced, which is why when you're selling them, you're going to make more than you ever have. Now, what about Hood? We got a bunch of guys ask questions about Hood. What is it that you want to see specifically on Hood, guys?
They want to see like what put we would sell on the hood. I mean, so I'm looking at the options chain. So we have tomorrow. Okay, so get this. So tomorrow you could sell a 98 put. So you see here, this is I know Jack doesn't he doesn't like worry about the Greeks at all. I know you do the trends. I know you use some moving averages though, right?
I do. Yeah, for the
So
trend on the stock. Stock is the most important thing in an options trade. So you got to have that thing trending higher, which Hood is, to
and
make it.
I see a bounce off of the 50, the 50. So if you look at the where we're kind of bouncing off, the 50 moving average is at 99. So you could literally you could make if you so right now the 90, if we come back over here, okay, so just keep this in mind, right? So $99 is basically where the moving average is. Hood's moving up over that. And the options, this weekly options chain or contracts, these expire on the 5th, which is tomorrow on Friday, right? So if you come back over here, we'll go back to Thinkorswim. Was I showing you Thinkorswim or were you seeing the chart? What do you see right now?
Options chain.
Ah, okay. Let me show you the chart real quick. So check this out. Okay, so look, here's the moving average, right? So this is the moving average is at 50 moving average. We bounced off of it. This is how I would think of it. I don't know what, let me know, Jack, but $99. Okay. I view that as a good support line, especially going in. We have 15 hour or we have a day and a half left basically in the markets. So by Friday, where do I think could go? I think it's probably going to stay above the 99. This is a pretty moving averages tend to be pretty strong support lines. So let's go back over here. Now that we kind of have that, then we have that, in our heads. So $99. If we were to go back over to our options chain, now look at this. You could maybe get what, 83, 84 bucks by tomorrow if you sold this put on Hood. If you want to be more conservative, and that's at the $99, that's at the moving average. So basically what you're saying is I don't want Hood, if you're selling a put, or if you don't want to actually collect on Hood, right? If you just want to collect premium, and you don't want to get assigned, you could say, okay, well, $99 is a strong support zone. I think it's probably going to stay above that until tomorrow expiration, right? This is the September 5th contracts. You could get, now it's like 79 bucks, in about a trading day and a half. Or if you want to be more conservative, you could get about maybe 56, 57 bucks. If you go 98, which is below the moving average, right? And if you just want to even be more conservative, but you want to sell more contracts, you could just get 38 in premium, and you get it basically. You could sell two contracts at 38 at $97. Collect 39 or so bucks. You could get maybe 80 bucks out of that. I know Jack doesn't use this, but I do. If you look at the delta, all this too, delta is basically a stand-in for probability of being out of the money, which is if you're just trying to collect the premium, you don't want to get assigned. It's helpful to target lower delta because that means basically This only has the $98 put only has a 20% chance of a 19% chance of expiring in the money, which is what you would want. So
Yeah, and if you get it at support, which you did a great job of showing that, and that's exactly how I do it. I find support, and then I'm gonna sell a naked put if I want the stock gifted to me. I'm gonna do it right at support. If I want it and I don't want a chance of getting it, then I'm gonna do what you said: pick a lower strike put deeper out of the money with a less likelihood of having it put to me. Or you can do 2 or 3 or 10, right? You could pick a bunch of different ones.
yeah,
So you want to see a bull put spread? That was just a naked put we showed you there. So if we were going to do a credit spread on Hood, we'd use the same type of principles. We would sell, for example, a 97 put and buy the 96. But you'd want to pick it further expiration out, because if we go just to tomorrow, there's no time value in that option, so we wouldn't make much premium. But if we did it for the following Friday's expiration, we'd have a little more cheese in it. So I'm not sure who asked for example of a credit spread, but a credit spread here would be exactly that. We would sell, for example, the 99 put. So we're saying we'd be standing to buy it at 99, and we'd sell the 98. I'm sorry, we'd buy the 98 put.
yeah.
And the difference between, let's say you can make 10 cents. Well, 10 cents on a dollar, that's a 10% return for a week and a day. That's strong. So that's how it is you're selling one put and you're buying a lower strike price put. But you have to do it on a stock that's trending higher. That way it's moving away from where your strikes are. Over time, it's moving higher. If it's moving lower, it's going to trend right down into your strikes, and you're going to have to take a loss.
And
So-
I think, late Tuesday, early Wednesday, I found for weeklies, if you're doing weeklies, is a good time, because Mondays are like price discovery day. Sometimes what happens Monday is not necessarily how it'll follow through the rest of the week, but once the weekly trend has been established, usually by late Tuesday, early Wednesday, it's a good mix of theta decay, which is what you want for a put spread, and being able to get some good premium for it.
Yeah, this is a good one for that.